When you buy something in India, who's actually on the hook for sending that goods and services tax to the government? You probably think, oh, it's always the seller, right? Well, that's not quite the whole story. Today, we're going to break down the 3 different ways GST is actually handled, so you'll know exactly who pays the tax and when. So here's our game plan. First, we'll look at the one thing that actually triggers GST. Then we'll cover the standard everyday rule. After that, we dive into a really interesting twist on that rule. We'll also look at a simpler option for small businesses. And finally, we'll wrap it all up by talking about why this whole system really matters to you. All right, so before we can even ask who pays the tax, we've got to figure out what kicks the whole process off in the first place. What's the starting gun that makes GST even a thing?
To really get it, you have to remember the chaos that came before. Seriously, it was a tangled mess of different taxes: central excise, state VAT, service tax, you name it. GST was designed to be this one single unified tax to just slice right through all that complexity.
And this, right here, is the magic word, the absolute cornerstone of the entire system. Everything, and I mean everything, under GST hinges on the concept of supply. If there's a supply of goods or services, boom, GST gets triggered. No supply, no GST. It's really that fundamental. Okay, so a supply has happened. The clock is ticking. Now who pays the tax? Let's start with the most common method, the one that you and I see pretty much every single day. This is called forward charge, and it's exactly what it sounds like. It's super straightforward. The supplier, say a shopkeeper, sells you something. You, the recipient, pay for it plus the GST. Then the shopkeeper takes that GST they collected from you and pays it over to the government. Think of it like a simple baton pass. You give the tax to the supplier, and the supplier passes it to the government. Easy peasy. But what if that baton pass went the other way? Now, this is where it gets really interesting, because the system has this fascinating twist that completely flips the standard rule right on its head. Let's put these side by side. In a normal forward charge, we know the supplier is responsible for paying the tax to the government. But under reverse charge, that entire responsibility shifts to the recipient. The supplier doesn't collect any tax at all. Instead, the person or company receiving the service has to pay the GST directly to the government. The whole thing is, well, reversed.
So the obvious question is why? Why on earth would this system be set up to do this? When does this twist actually happen?
Well, it only happens in specific situations that the government has officially listed out. For instance, when a law firm gives legal advice to a big company, it's actually the company, the recipient of the service, that pays the GST. The logic here is pretty smart. It's often used when the customer is a bigger, more organized business than the supplier. It just makes collecting the tax more reliable for the government. Okay, so we have the standard rule and its big exception. But what about the little guys? The small businesses, where all this complex paperwork can be a total nightmare. Well, thankfully, the law has a much simpler path just for them. The question is there a way for businesses that are just starting out or don't have a massive turnover to just simplify things? Yes, there is, and it's called the composition levy. For most businesses dealing in goods, if your total turnover in the last financial year was 1.5 crore rupees or less, you can choose this scheme. But that limit isn't the same everywhere. For some special category states like Sikkim, Mizoram, and Tripura, the threshold is a bit lower. It's set at 75 lakh rupees. And hey, what about service providers? They aren't left out. There's a similar option for them too, as long as their turnover was up to 50 lakh rupees in the previous year. So, you might be thinking, what's the catch? It's really all about a trade-off. The pros are fantastic, compliance is way simpler, you pay a low fixed tax rate on your turnover, and payments are just quarterly. But the cons? They're pretty significant. You can't claim any input tax credit on your purchases, you can't collect tax from your customers, and you're not allowed to sell goods outside your state. So it's a choice. Do you want simplicity, or do you want the full benefits of the standard GST system? Okay, deep breath. We've walked through the 3 main ways GST gets paid. So let's bring it all home and talk about why understanding this stuff is actually so important for everyone. This table really nails it. You've got forward charge, the default, where the supplier pays, then reverse charge, the special case where the recipient pays, and finally, the composition levy, the simple option for small businesses where the supplier pays a flat rate but gives up their input tax credit. 3 systems, 3 very different answers to that one big question: who pays the tax? And here's the bottom line. It doesn't matter if you're the one selling,
the one providing a service, or the one buying. You have to know which of these three gears is turning in your transaction, because that's what determines who is legally responsible for paying the tax and doing the paperwork. And believe me, getting that wrong can cause some serious headaches.
So, I'll leave you with this to think about. Now that you know who pays, think about how that could change everything for a business. Could the reverse charge rule make you choose one vendor over another? Could the limits of the composition scheme hold back your plans for expansion? You see, the answer to who pays isn't just about taxes. It's a core piece of business strategy.